Suppose a credit card company lets you borrow $6,000 for 15 months at 0% interest. Is that genuinely free money, or is it a carefully designed trap? The short answer is that a real 0% purchase offer can be useful, but it is only free float when the repayment money already exists, stays protected, and reaches the card before the promotional clock runs out. Without that system, 0% debt can quietly turn into some of the most expensive debt you have. This question matters because the number on the advertisement is not the whole deal. You also need to understand what the promotion covers, when it ends, what happens to new purchases, and which payment amount actually gets you out of debt. Start with the basic mechanism. APR means annual percentage rate. On a normal credit card, the issuer may calculate interest daily using your balance and a daily version of the annual rate. If you pay the full statement balance by the due date and your card provides a grace period, you can usually avoid purchase interest entirely. A 0% purchase promotion temporarily changes the interest rate on eligible purchases. During the promotional period, that balance still exists, and you must still make at least the required minimum payments. But the promotional purchase balance is not generating interest while the 0% rate applies, assuming you follow the offer's terms. That creates two completely different ways to use the same card. In the first version, you buy a $6,000 appliance package. You already have $6,000 in savings, but you keep that money in a separate savings account while paying the card down on schedule. The debt is fully backed by cash. In the second version, you buy the same appliances because the card makes the monthly payment look manageable. The $6,000 does not exist anywhere. You are depending on future income, future discipline, and future good luck. Both balances say $6,000. Financially, they are not the same situation. The first is closer to controlled free float. The second is ordinary consumer debt wearing a 0% costume. Here is a simple example. Assume you borrow $6,000 at 0% for 15 months. You could divide $6,000 by 15 and plan to pay $400 a month. But that uses every available month and leaves no room for a processing delay, a mistaken end date, or an unexpected expense. A safer calculation uses 14 months. $6,000 divided by 14 is about $429. Round that up to $430 a month, and the balance should be gone roughly 1 month early. Now, imagine you already had the $6,000 and kept it in savings, earning an assumed 4% for 1 year. That would produce roughly $240 of gross interest before tax if the rate stayed unchanged. That is a real benefit, but notice the trade-off. You are managing $6,000 of revolving debt to earn around $240. A single mistake can erase much of the gain. If $1,000 remains after the promotion and the regular rate is 25%, roughly 6 months at that rate could cost around $125 in simple interest. Actual card interest is commonly calculated daily, so the exact amount will depend on the balance and payment dates. If you enjoy clear explanations of the rules hiding inside everyday money products, subscribe. The goal here is not to label every financial tool good or bad. It is to show what has to go right for the tool to work. The first major misunderstanding is confusing a true 0% APR offer with deferred interest. A true offer may say 0% introductory APR on purchases for a certain number of months. If a balance remains when that period ends, the regular rate generally starts applying to the remaining balance from that point forward. Interest from the 0% months is not normally added retroactively. Deferred interest is different. You often see language such as no interest if paid in full within 12 months. The word if is doing a lot of work. If you fail to pay the qualifying balance in full by the deadline, interest that was building in the background may be added going back to the purchase date. Imagine a $400 purchase. You pay $300 during the promotional period and leave $100 unpaid. With a true 0% promotion, you finish the period owing the remaining $100, and regular interest begins from there. With deferred interest, you could owe the $100 plus the interest that had been tracked throughout the promotion. The offers can sound similar in an advertisement, but the end of promotion consequences are radically different. The second misunderstanding is believing that the minimum payment is a repayment plan. It is not. The minimum is the amount required to keep the account from becoming delinquent. It is designed around account servicing rules, not around your personal deadline. Paying only the minimum may leave a large balance when the promotional rate expires. This is why the correct monthly payment starts with the amount borrowed and the number of months available. Do not start with the minimum printed on the statement. The third misunderstanding involves grace periods. A grace period is normally the time between the end of a billing cycle and the payment due date. When you are not carrying a balance and pay the full statement balance on time, it can allow you to avoid interest on new purchases. But promotional balances can make the account more complicated. A card may track purchases, balance transfers, cash advances, and promotional amounts separately. Different balances can have different rates. Payment allocation rules can also determine where money above the minimum goes. When the purchase promotion ends, the regular APR may apply to what remains and to new purchases. Depending on the account terms and whether you are carrying a balance, new purchases may also lose the normal interest-free grace period. That means using the card for groceries while trying to finish an old promotional balance can create a messy combination of balances and interest calculations. The cleanest approach is to stop putting new spending on the card before the promotion ends. Once the balance is cleared and the issuer confirms how the grace period works, the card can return to normal use. The fourth misunderstanding is treating the promotional period as a vague number of months. The real deadline might be tied to account opening, a particular billing cycle, or an exact date shown in the agreement or app. 15 months does not necessarily mean that a purchase made later receives 15 full months. The countdown may have started when the account opened, so you need a calendar system, not a memory system. When the account opens, record the exact promotional expiration date and the regular APR that follows it. Set automatic payment for at least the minimum as protection against forgetting a due date. Then schedule the larger monthly repayment separately. Create 3 reminders. The first should be about 90 days before expiration. Check the remaining balance and compare it with the cash reserved for repayment. The second should be around 60 days before expiration. Stop new purchases on that card and correct any payment shortfall. The final target should be 1 full billing cycle before the official deadline. Pay the promotional balance to 0, wait for transactions to settle, and verify the account rather than assuming the job is finished. This buffer also matters because a late or missed minimum payment can trigger fees and, depending on the agreement, may put the promotional rate at risk. Autopay reduces that danger, but it should not replace checking the statements. A changed bank account, a returned payment, or a payment scheduled for the wrong amount can still cause trouble. There is also a credit score trade-off. A large promotional balance may increase your credit utilization, which is the share of available revolving credit you are using. Even with no interest due, a high reported balance can affect credit scoring. That may matter if you expect to apply for a mortgage, car loan, apartment, or another card before the balance is paid down. So when is a 0% purchase card genuinely useful? It can be useful when the purchase was already planned. The price is not inflated because financing is available. The monthly payoff fits comfortably inside your budget, and the repayment cash is either already available or being built automatically. It can also preserve liquidity during a large, necessary purchase without immediately draining every dollar of an emergency fund. But it becomes dangerous when 0% changes what you buy. If you would spend $2,000 with cash, but $6,000 with promotional credit, the financing has not saved you money. It has increased the purchase. It is also dangerous when the plan depends on opening another promotional card later. Moving debt from one temporary offer to the next can feel like progress because interest is delayed. But the principle is still there. Transfer fees may apply, approval is never guaranteed, and future credit limits may not be large enough. The most useful mental model is simple. A 0% card does not remove the cost of a purchase. It only moves the payment deadline. If the money is protected, the payoff is automated, and the account reaches zero early, the offer can provide controlled free float. If the promotion is being used to make an unaffordable purchase feel affordable, the deadline is eventually likely to expose that gap. 0% is a rate, not a plan. The plan is the calendar, the monthly payment, the cash reserve, and the decision to stop spending before the clock reaches zero. If you have a question about promotional cards, grace periods, or how credit card interest works, leave it in the comments. And tell me which money rule you want broken down next.